Gold and silver are not rising by accident. This is not a rally. It's a warning. What's pushing gold and silver up is bigger than prices. For thousands of years, gold and silver have survived every empire, every war, and every currency collapse. Kings trusted them. Traders relied on them. Ordinary people hide them away when times becomes uncertain. Today, something familiar is happening again. Gold and silver prices are rising, not because of hype or headlines, but because of quiet forces working beneath the surface of the global economy. Forces most people never see until it is too late. This documentary explores those silent forces and explains why gold and silver are becoming more valuable in the modern world. To understand why gold and silver are rising, we first need to understand money itself. Modern money is no longer backed by gold or silver. It is created by governments and central banks with the push of a button. When economies slow down or debt grows too large, more money is printed to keep the system running. At first, this feels helpful. People receive stimulus checks. Interest rates drop. Spending increases. But there is a hidden cost. When more money is created without real value behind it, each existing unit of money becomes worth less. Prices rise. Savings lose purchasing power. What once bought a week of groceries now buys only a few days. Gold and silver cannot be printed. Their supply grows slowly through mining, which takes time, labor, and real cost. This natural limit is why they protect value when paper money weakens. As currencies quietly lose strength, gold and silver quietly rise. Inflation is often described as temporary, but history tells a different story. Once inflation enters a system, it rarely leaves quickly. Higher wages lead to higher prices. Higher prices lead to higher borrowing. Higher borrowing leads to more money creation. This cycle feeds itself. Gold and silver react not to today's inflation numbers, but to long-term trends. Investors and central banks know that inflation reduces the real value of cash and bonds. That is why gold performs best when people stop trusting official promises and start protecting purchasing power. Silver follows closely, not only as money, but as a metal deeply tied to industry and technology. Inflation does not shout. It whispers. And gold and silver respond to those whispers long before the public notices. While many people focus on stock markets and cryptocurrencies, central banks are doing something very different. They are buying gold. In recent years, central banks around the world have increased gold reserves at levels not seen in decades. This is not accidental. Gold has no counterparty risk. It does not depend on another country's promise to pay. It cannot be frozen, hacked, or inflated away. When central banks add gold to their reserves, they are signaling concern about the stability of the global financial system. They do not announce fear openly. They prepare silently. And history shows that when central banks buy gold in large quantities, prices tend to follow. Global debt has reached levels never seen before. Governments borrow to pay old debts. Corporations borrow to survive. Consumers borrow to maintain lifestyles. Debt works when growth is strong. But when growth slows, debt becomes a trap. Higher interest rates make debt harder to repay. Lower interest rates weaken currencies. There is no easy solution. Gold and silver exist outside this debt system. They do not depend on interest rates or repayment schedules. As confidence in debt-based systems fades, real assets gain strength. This shift does not happen overnight. It builds quietly, until suddenly it becomes obvious. Silver is often called gold's shadow, but its role is unique. Silver is essential for solar panels, electric vehicles, medical equipment, and modern electronics. Every smartphone, computer, and electric grid relies on silver in small but critical amounts. Unlike gold, much of the silver used in industry is never recovered. It is consumed. At the same time, mining supply struggles to keep up with demand. New silver discoveries are rare, and mining costs continue to rise. This creates a quiet imbalance. When investment demand increases alongside industrial demand, silver prices can move quickly. Silver does not need hype. It needs scarcity. Trust is the foundation of every financial system. People trust banks to hold money. They trust governments to manage economies. They trust markets to remain fair. But trust erodes slowly. Bank failures, frozen accounts, currency controls, and market manipulation all leave scars on public confidence. Gold and silver require no trust in institutions. They are assets you can hold, store, and transfer without permission. As trust shifts away from complex systems, simple assets regain importance. This is not fear-driven behavior. It is historical behavior. Every major financial reset in history followed the same pattern. First, debt expanded. Then money lost value. Then trust weakened. Finally, people returned to hard assets. Gold and silver have survived every version of money humanity has created. They are not exciting. They are not fast. They are reliable. And reliability becomes priceless when uncertainty grows. The rise of gold and silver is not driven by speculation. It is driven by silent forces working over years, not days. Currency dilution. Persistent inflation. Central bank behavior. Unsustainable debt. Industrial demand. Eroding trust. These forces do not reverse easily. Gold and silver do not promise riches. They promise survival of value. And in times like these, that promise matters more than ever.